The Dow plunges 2,200 points as tariff tumult rocks the market. Airlines are expected to cut their 2025 outlooks as travel demand falters. The IMF warns of economic slowdown linked to US tariff policies. As stagflation fears rise, prepare for higher prices and unemployment. I don't even know what the word stagflation means, but it sounds bad. So whether we like it or not, the recession is here, or at least it's knocking louder and louder each day. So I set out to find stocks that could thrive during a recessionary time, but I didn't want to do it the old way. So I asked myself the question, can AI pick better recession stocks than Wall Street? So I asked ChatGPT, Gemini, and Grok, and their answers surprised me. I didn't stop there though. I asked it to explain why each stock it picked was a safe pick, not just throw up a bunch of ticker symbols. Anyone can list a bunch of safe stocks, but can they actually hold up when things get ugly? What makes a truly recession-proof stock? And are the usual suspects like Apple, Amazon, Google even the right picks during a time like this? In this video, I'll show you 3 stocks that the AI tools picked. We'll talk about how I structure my prompts and how you can do the same to protect your own portfolio. Let's go. First, I asked the AI tools, what are the safest stocks to own during a recession? It turns out that that's not a very good prompt. In the case of Gemini, it gave me broad sectors to own. So it talked about what the defensive sectors were, consumer staples, healthcare, and utilities. Well, we could have typed that into Google and got the same answers. We're looking for something more specific that gives us an edge. It gave us some additional ideas that were interesting, but it gave us no stocks. It gave us key characteristics of recession-proof stocks, but that's not what we asked. We asked it for the safest stocks to own during a recession. ChatGPT wasn't much better. It answered my questions with questions. That's often a good thing, but it pointed to something more important. I had given the tools a prompt that was too broad, and broad prompts lead to broad answers, which isn't what we are after. The lesson for us here is we don't want to suspend our minds when using these tools. The tools have the capability to make us much better investors when we ask them smart questions, and that's what we're gonna do. So I tested a bunch of prompts and found a few that gave me gold. Then I asked which stocks performed well during the 2020 recession, and I got some very interesting names like Netflix, Amazon, Nvidia, Microsoft. That's really interesting. It also gave me some other names like Gilead Sciences, Regeneron Pharmaceuticals. Those might be some that you might expect to do well. I was a little surprised by Netflix, Amazon, Nvidia, and Microsoft. But that got me thinking, are there some stocks that might perform well in one recession and not necessarily perform well in the next one? The truth is that each recession is different and is driven by different factors. And those factors that drive each recession could present opportunities that are different than we all might think. So I asked a different question. What stocks outside of the traditional safe sectors might do well in a tariff-induced recession? And I struck even more gold. So our first pick is, yawn, Coca-Cola, of course, a consumer staple, but hear me out. It's been a consistent revenue grower, grew revenues even through the 2008 and 2020 recessions. It's got strong free cash flow in 2024 of $4.7 billion. Its price to earnings ratio is right around its 10-year average. And get this, it's increased its dividend for 64 consecutive years. It has operations in over 200 countries, which means that it's not limited by the economic circumstances in any one country. And it's got a great product range, not just the drinks we think about, but snacks and meals as well. It has also significantly outperformed year to date, up almost 17% for the year, while the rest of the market is down about 6%. But I get it, that's not what you came for. You came to find stocks that others would not consider recession-proof or recession-resistant to give you an edge for the protection of your portfolio. This second pick was just that. It actually surprised me. This second pick is a very interesting one because it's not in one of the core traditional recession-proof sectors like healthcare, utilities, and consumer staples. It's a consumer discretionary stock and one that we all probably have in our homes. It's Netflix, ticker symbol NFLX. So how did Netflix turn into a potential recession-resistant business? Well, let's look at its performance in the last 2 recessions, the 2008 recession and 2020 recession. In the 2008 financial crisis, it was up 12.5%, while the S&P was down 38.5%. That's a 50% outperformance range. In 2020, it gained 65%, while the S&P returned about 18%. in that year. So it's been building a track record over the last 2 recessions as a recession-resistant stock. The company has continued to grow its revenue and its net income by 16 and 18% respectively. Its cash flow is very strong at $1.38 billion, and it's got about $10 billion in cash in hand. This one doesn't have a dividend, which is a characteristic of many recession-proof stocks. But with those growth rates, I think I, as an investor, will be fine owning the stock through a recession. It looks like other investors might have gone into Netflix because it's up 24%, while the S&P is down roughly 6% so far year to date. All right, this next one I really should have thought of because it's something that we use every day, could really be considered utility, but it just isn't in the typical sectors of consumer staples, utilities, or healthcare. And that stock is T-Mobile. Our phones have become indispensable parts of our lives today. And T-Mobile is one of 3 large providers of phone service. Heck, you could even make the argument that it's more than just providing phone service. It's providing life service. We work on our phones, we learn on our phones, we do business on our phones. They've become indispensable parts of how we carry out our day-to-day lives. In addition to all of that, it's got strong cash flows, it pays a dividend, and it's continued to grow by expanding its fiber optic networks. So how did it perform during the historical period? Well, it performed better than the S&P 500. The S&P 500 was down by 38%, and it was down less. And during the COVID pandemic period, it was up significantly more than the S&P 500, which was up roughly 43%. It continues to show its resilience this year by being up about 8%, while the S&P is down 6%. One thing to note here is that it can be very difficult to find recession-proof stocks. While they might outperform the market, it doesn't mean that they won't go down. Some examples of this are Johnson & Johnson and Procter & Gamble. The market was down 55% from 2007 to 2009, but they were also down. They were just down a little less. So it's important to know that the stock market is a risk engine, and whenever you put dollars in, you have to recognize that there's a chance that you could lose some of it. So why don't you try this analysis yourself using different AI tools to figure out what stocks you'd be interested in investing in. Start with the broad question, filter the list you get by past performance, sector, and financial strength. Test it across multiple AI tools. Look for overlap and divergence, and ask yourself the critical questions. Remember, having the AI tool doesn't mean that we turn off our minds. To be great investors, we use it as an assistant to accelerate our analysis of the kinds of businesses that we'd want to own in our portfolios. If you want to see which undervalued stocks could give you more upside than the ones that we just talked about today, I talked about those in my last video. Click the next video to see 3 cheap stocks AI helped me uncover, and the last one I can't stop thinking about. Like and subscribe. I look forward to seeing you in the next one.